I'll be back very shortly.
Okay, thank you. You can leave it in my mailbox. Just leave it in my mailbox. It's okay. Thank you. Okay, folks. As I was writing the quiz this weekend, I was navigating this very fine path. When you do DCS, a lot of number crunching, so that takes time. So you could just get stuck in the mechanics or stuck in the big conceptual issues. So the first round that I wrote, and I tried out on my own. I usually try out my own quizzes to see how long it takes. I said this is going to take too much time. So I started taking stuff away, which would take time, and I'm not sure I got that balance right. But you really didn't need too much number crunching to get to the numbers, because, let's take the first problem, right? The first problem had two levels to it, right? It's a single company with what? A product that's working its way through the pipeline, and I have 5 years of waiting before I find out. And there's a 60% chance that this could be a blockbuster drug, and then I give you the cash flows. You know what takes you time? Is if you don't trust the present value of an annuity equation. If you're still writing 15 years of numbers and discount, please stop, right? It's such a waste of time. Trust me, the annuity formula works. The payment button on your calculator is there for a reason. $1 billion every year for 15 years, the present value of an annuity. You get the present value, multiply by 0.6. And what's the last step? You got to bring it back 5 more years, right? Because you got to wait till 5 years from now to find out. So it's 3 layers. The initial round, when I wrote the quiz, I actually had negative cash flows for the next 5 years because of expenditures going. I took that out because that would be a layer. In fact, if I had thrown in that they have to spend $50 million every year for the next 5 years, what would you have done differently? You'd have to discount the $50 million back. Would you apply the 60% to it? No, you have to spend the money, and then you find out. So it's actually 2 layers there. Okay? So it's more of that decision tree, discrete risk. The second problem is purely deciding whether to add something, subtract something, or leave it out, right? So you cash, add, subtract, leave it out. Add. And I did throw in the fact, just in case you started getting worried about cash being discounted, what did I add to the problem to make that concern at least dissipate? That they earn their cost of capital. So you can count the cash as cash. In fact, the only part of that second problem where, in fact, most of them it's a half point. You're adding, subtracting, or leaving it out, is that cross-holding they have in another company, right? They consolidate the company. What did I give you about the other company though? I gave you the market value of equity in the other company. So what do you need to do with that market value? You've got to subtract out 20% of that market value because it doesn't belong to you. So that's all it requires. Each item asks yourself, and in fact this is a test we ran. Have I already counted it? If I've counted it, then I can't count it again. If not, I've got to count. I did throw in that debt. What was that accounts payable stuff? Why should I leave it out? Where have I counted? If I'm leaving it out, I'm saying I counted it. It's in working capital, which affects my free cash flow to the firm. It's already in there. So anything you've counted in, you don't double count again. The third 3A, I know, was a lot of line items and a lot of numbers, right? But your DAR was constant. The only number which was changing was actually the revenue, the operating. The DAR was constant, the CapEx was 0, right? I said you don't have to reinvest for the next 3 years. And there are no working capital requirements. What did I put in working capital? Oh, I did actually. What did working capital decrease by 10 million a year? So it's a plus 10. So it's pure mechanics basically again. And 3B. The only thing I didn't want you to be doing is taking your year 3 number from 3A and growing it out at 2% forever. Why can't you do that? Because in year 3, what do you have? No capex, decreasing working capital, so you're getting cash from your business. You let that grow 2% a year. It can't happen. You don't have the cash flows to sustain it, so you have to compute what your reinvestment has to be in year 4. It's almost like you have to do that always in evaluation. Never take, in fact, this is something I think I've returned out of all of DC evaluations, all but 7. The last 7 that I'm holding on to is not by design, it's just by, I couldn't get to them this weekend, I was working on them today. I'll get the remaining 7 to you by the end of tonight. Okay? But one of the things I was looking at is if you're building your own model, that's one of the things I was checking to see is, are you building in that extra year and doing the whole cash flow? Because if you don't do it, it's so easy to just take that year 10 number or year 5 number and grow it out, because that's going to overstate the terminal value. And 3C. What's the effect of why does an NOL even matter to you? What does it do for you? It saves you taxes, right? In fact, if you had the income right now and you could claim it right now, what's the value of a 40 million? No, I don't even remember what the NOL was. Was it 40? It's 16 if I can get the income right now. The only catch here is you still get the 16, but you have to wait. Why? Because you're still losing money till you get to year 2 and 3. So you have 16 million NOLs tax savings in years 2 and 3. You just discount them back, which is what you did in your cash flow analysis. So it's going to be less than 16 million, obviously. I don't remember what it was, like 12 point something million or so. Because you can't, and the key is again to remember that the reason you're losing value is because you have to wait and there's risk. You see what the risk is? You might never make the income. This is your expected income, you might not make it. That's why we don't discount it back at the risk-free rate or some lower rate. We use the cost of capital.
Sorry, I'm a little confused. At least in mind, they didn't realize the benefit of the NOL until year 3?
The full benefit. It starts in year 2. So you have some benefit in year 2 and some in year 3. You start making money in year 2, right? Yeah, you definitely do. Okay? So you start making money in year 2 and then you make the rest. So basically you get some of the NOL in year 2, in which year you pay no taxes. Maybe that's why you miss the NOL effect, is it shows up as that year if you'd had no NOL, you'd have had to pay 60% of whatever that income was. Because the NOL, you pay no taxes in year 2. You pay taxes in year 3, but you don't pay the 40%. You pay less than that. So the tax savings is the present value of that. Right? So sunk cost, let it go. Sid is, that was actually one of the TAs for the class. In case you don't know, he's actually putting it in alphabetical order because of this freakish need to have everything in alphabetical order before I start grading. So by the time I get back to my office, hopefully everything will be ready to go. And I'm going to go. And you get the usual thing. When I'm done, I'll send you the email, come pick it up. Don't leave it sitting out there. I still have some of your first quizzes. I don't want them, but I still have them. Okay? So if you still haven't picked up your first quiz, do so. So today I want to start off with something I left you with on Wednesday. We're talking about consistent multiples. Somebody remind me again. What's a consistency rule? My numerator is a equity value. My denominator has to be an equity value. My numerator is an enterprise or an operating asset value. My denominator has to be an enterprise or an operating asset value. And I asked you to think about EV to EBITDA, right, where you have consolidated. Okay. It's a mess when you have minority holdings for a couple of reasons. Okay. Let's assume you have a 60% holding of another company, and you're trying to compute the EV to EBITDA for this company. So help me along. What's the definition of EV to EBITDA? I take the market value of equity of your company. And what does the market incorporate into your value? 60%, the 60% you own or 100%? The market's not stupid. It says you own only 60%. It takes 60%. So you get the market value of equity. It reflects only 60% of the subsidiary. Then you go to the financial statements for your debt and cash and EBITDA. And because accountants consolidate, you're going to be counting 100% of the debt, 100% of the cash, and 100% of the EBITDA. Do you see the problem here? Your market value of equity is incomplete, in a sense, relative to every other number. So you know what analysts do to try to correct for this, to try to get back to wholesome multiples? What do they add? What do they add to the numerator? In theory, they should be adding the 40% of the subsidiary's equity value to the numerator to make it whole again. But they just add the minority interest. What's the problem with that? That's a book value. So basically you have a market value of equity plus debt, equity, and EBITDA coming from consolidated plus a book value. It's a complete and total mess. And if you have a company with a lot of cross holdings, just try to forget about using it. Just compute it for that company. It's problematic. So if you get a chance, take Yahoo and compute the EV to EBITDA, you'll see exactly what I'm talking about in terms of cleaning up for it. Yes, sir.
I would understand why a company would do that if they have cross-holdings that are privately held company, but wouldn't it be easier to do it for a publicly held company?
I'll tell you why it becomes problematic. You're assuming there's only one cross-holding, right? If there are 11, people finally throw up their hands and too messy, I'm just going to do it. It's not an issue if the cross-holding is in a small company. Disney has a majority holding in some $2 billion company, or Apple has a cross-holding in a $5 billion, who cares? But if that cross-holding is in a company of roughly your size or larger, then it's hugely problematic. Okay? I'm actually going to argue that when we get later to multiples, and maybe if you're going to, remember after all, you're going to use this multiple to compare across companies, right? When you consolidate and you create this combined EV to EBITDA, what have you just done? You've taken a weighted average of two companies' EV to EBITDAs, right? A parent company, a subsidiary. My question, who are you going to compare it to? Maybe you're better off just making a parent company EV to EBITDA and a subsidiary EV to EBITDA and doing two separate comparisons. Okay? You think that's a pain in the neck? I know that's why you ran away from DCF valuation, but as I said, everything you run away from is still lurking in the background. You just don't look at it when you often use multiples. So I'm going to stay on this consistency number, and I'm going to actually put up a graph of a ratio that is computed sometimes in housing. And some real estate people treat this as a measure of whether there's a bubble. What they do is they take housing prices. So let's take any region, any part of the world. They take the average housing price and they take the rental income you would get by renting out the house, and they divide the housing price by the rental income from the house. They come up with a ratio. This actually is a graph from earlier this year on what that ratio looked like in the US. So the way to read this is you go to the West Coast, a typical house trades or sells for about 16 times rental income. That number, if you go to San Francisco, is like 25 times rental income. But in Central California, it might be 11 times rental income. Okay? Obviously, the number is lower. But the way people use this number is when this number gets really high, you have a real estate bubble. The argument being that what you charge for rent reflects the actual value of the property. What you are willing to pay for something is because you got into the pricing game. You're buying that piece of the house in San Jose because you think you can sell it to somebody else. You've stopped thinking about cash flows. Now, I'm not a real estate person. I'm not even going to argue that this is a good ratio. But let's assume you're going to use this ratio to decide whether you should put your money in housing or stocks. In other words, you want to compare this ratio to what you're paying for stocks. So here's my first question for today. What multiple So basically you got the housing price multiple. Which multiple in the equity market would you compare that housing price to rent to? And I'll give you the choices. Remember, you have to be consistent. Equity multiples get compared to other equity multiples. So the real question I'm asking is, the multiple that I showed in the housing market, is it closer to a PE ratio, an EV to sales, an EV to EBITDA, or an EV to EBIT? So we know what these multiples are, right? So the question is, what is that? What's in the numerator there? Housing price, right? That's just not the equity you invest in the house. It's the total price of the house. It's more like enterprise value. The rental income, it's not really a cash flow, right? It's, there's depreciation you might get. We're not considering that. So it's like an operating income, but you might have other expenses associated with it. I mean, I'll just make a guess here. I think you're closer to EV to EBIT with housing price to rental income than you are to any other multiple. So if any of you are considering where should I invest my money, maybe this is the ratio we should start tracking. Is housing a better deal as an investment, or is stocks? Maybe we should be making comparisons to it. Right? Any questions? Yes?
I thought you said the rental income doesn't include D&A, so wouldn't it be closer to EBITDA?
No, basically, if I wanted to make it EBITDA-like, I have to add because what people do with rental income, this act of do you rent or do you own, when in fact what they should be asking is, are you buying the house and renting it out? If you rented it out, you'd get the rental income, but you'd also get the depreciation amortization on top of it.
Okay. Does the rent in the price to rent ratio include any other operating expenses?
Nothing. It's just basically rental income. So it's kind of this, that's why I'm saying it's like a guess. I'm not even sure what it measures because you're not even asking the consistent question all the way through. But I think that it's a bit of a mess when it comes to it, but definitely can't compare to PE ratios, which is what I've seen people do it in practice, is they just compare to PE ratios. Right? So that's the first step in the process, is define the multiple. So the next time you run into a multiple, stop and ask a question. Is it consistently defined? Is it uniformly estimated? Is it estimated the same way across the companies? Tough test to me. Second stop along the road. Get a sense of what the multiple looks like. This is not a financial analysis, it's a statistical analysis. Remember, anytime you get data and statistics, what are the first two numbers you compute? What's the average? What's the standard deviation? Do that. But don't stop there. Draw a histogram of the data. Basically start counting. And what you're going to notice very quickly is that the distribution is not symmetric. Rather than talk in abstractions, let me show you a distribution of PE ratios for the US at the start of 2015. So I've been doing this for about 25 years. At the start of every year, I take the PE ratio for every company. Current PE, trailing PE, forward PE. I compute it for every company for which I can compute a PE. That sounds like a strange thing to say, but for which I can compute a PE. And then I start counting, and I put it up in a histogram. See what I mean by not symmetric? A symmetric distribution, of course, would be like a normal distribution. The average would be, but clearly this is not symmetric. The peak is to the left, the tail is to the right. In fact, I've artificially cut off the tail, right? You see what I mean by artificially cut off the tail? I stopped and said any company with the PE ratio greater than 100, I'm just going to put in that last pile. Because if I didn't do this, the entire distribution is going to have a little peak and the tail is going to stretch out forever. And we talked about why this matters. When you have an asymmetric distribution, we said the average gets pulled out by outliers in whichever direction you have the skewness. In this case, the big positive outliers are going to pull out the average. Again, rather than talk in abstractions, let me show you what the statistics look like for PE ratios for US companies at the start of 2015. The average PE for a US company is 72. Shocking, right? If I told you the average US company is trading at 72 times earnings, you're going to freak out. But it's technically true. The average PE is 72. But the average is 72 because there's some dumb company trading at 23,100 times earnings. And that number last year was 757,000 times earnings. Last year's high number. So how can that be? Well, if your earnings per share drops the fraction of a cent and your price is like $8, you can end up with an 800,000 PE. And when you compute a simple average, that's exactly what's going to happen. The median, which is a more reasonable number, is 21. That's pretty high by historical standards. But that's a number we should be focusing on. So if I came to you with a company with a PE ratio of 17 today, your historical perspective, your framing might say that's a high PE. But relative to how other companies are being priced, a company with a PE of 17 today is cheap. It's a strange definition of cheap. If you enter the relative valuation realm, it's no longer your judgment or my judgment as to what is cheap. It's the market's judgment. And the market's judgment right now is 21 times earnings is a median company. If I keep going though, there's another factor about these multiples that I have to point to. See the number of companies with a current PE 3,403? There were 7,887 companies in my sample. So that's Excel spreadsheet. But I was able to get PE ratios only for 3,400. So what happened to my other 4,000? In fact, when your earnings per share becomes negative, what do you report as a PE ratio? You don't take price and divide by negative earnings per share. You report not meaningful, not available, right? Here's a nice trick question to ask. So you'll soon be interviewing other people, so you can torture other people. What's a median PE for a US stock? Well, more than half the stocks have not meaningful. Maybe not meaningful is the PE ratio for a median stock. That's a lot of companies. But here's the reason you need to worry. In statistics, you're allowed to sample, right? You have a pretty big sample still, 3,400 companies. But I'm actually losing 4,300 companies, not randomly, but because they're losing money. I'm taking out of my sample a subset of companies, and a pretty big subset, of money-losing, small, risky companies probably. What I'm left with is a biased sample. And if I draw judgments based on the biased sample, I might be making some very bad mistakes about where to invest and where not to invest. One of the things we're going to examine is, how do I know which multiple is right? I'm working within a sector. How do I know which multiple is right for my sector? Biotechnology, cable, whatever. Here's a very simple rule. If you start losing 2/3 or 3/4 of your sample in the process of computing a multiple, don't use it. Because if you do, you're going to end up with this really small subsample of companies, which is really not indicative of how this sector is being priced. I've wrestled with this almost every year when I compute industry averages. Because the first couple of years when I computed industry averages, here's what I used to do. I used to take the PE ratios of every company within each industry for which I was able to compute a PE and compute an average. And I very quickly learned after about the second year that this wasn't going to work. Because you'd take a sector like biotechnology and you'd have 35 companies, only 2 would be making money. I'd compute the PE ratio for those 2, then what would I do? I'd average the 2 and say this is the average for the sector. That's not really true, because that's 2 out of 35. So when you look at these distributions, it's not just a statistical problem, it's a problem that you're going to find in using it. In fact, as I go from current PE to trailing PE to forward PE, the medians drop off, partly because earnings are climbing as I go. But the number of companies in my sample also drops off from 3403 to 2820. How come? Why am I losing companies as I go from current PE to forward PE? It could be that they're losing money next year, right? But that wasn't really the reason. In most of these companies, earnings were rising. This is in 2008 or 2009. What do I need for forward PE? I need expected earnings in the next 4 quarters, right? There's no way I'm sitting down estimating that for 7,887 companies. So what do I look for? An analyst forecast of earnings. So who am I losing? Any company that's not tracked or followed by analysts is out of my sample. Is that a problem? I think so, because the kinds of companies that are not tracked or followed by analysts tend to be different from the other companies in the sector, and that creates bias again. We create bias by the choices we make about how to compute multiples, what multiple to use. And if you're not careful, that itself will drive your end decision about whether to buy something or sell something. So that's the first thing. Until probably 2002 or 2003, I used to do this just for US companies. Then I'd go to Brazil or I'd go to India and I'd show this distribution and talk about PE ratios not being symmetric. And an analyst in the audience, usually in his 50s or 60s, would put up his hand and say, it's not like that in Sao Paulo. I said, not like what? So I don't think PE ratios in Brazil are like that, like your graph. So how do you know? Gut feeling. After about the 5th or 6th time of hearing gut feeling tell me that Brazilian stocks are not asymmetric or Indian stocks are not asymmetric, I started doing this for the rest of the globe as well. So every year since 2003, I've kind of created this consolidated graph where I take every part of the world and I compute this histogram. I do it on percentage terms so you don't have big differences in numbers driving it, because it gives me a sense of what's similar across the world and what's different. So these are PE ratios in January 2015. So focus on the median numbers. The most expensive market in the world in January 2015 is the US, close to 20 times earnings. The cheapest market in the world is Japan at 14.05 times earnings. That's not always been the case. I think for a stretch of almost 20 years, from the late 80s to almost 2003 or 4, Japan used to have the highest PE ratios in the world. You know why? The risk-free rate in the Japanese yen used to be 1.5%. The risk-free rate in the US dollar used to be 5, 6, 7%, the same in the euro. So what's changed? The yen has gone even lower, but everything else has kind of converged on the yen, right? The euro risk-free rate is close to 0.2%, the US dollar risk. So as risk-free rates have converged, Japan has gone from being the most expensive market in the world to the cheapest market. Right? Emerging markets actually have a higher PE ratio than Europe does. Again, something that never used to be the case. Emerging markets used to be the discounted markets. For a decade, you could buy emerging markets at a 25% discount in developed markets until 2008. Post 2008, emerging markets have drifted up and developed markets have drifted down. They've kind of met in the middle. The world is changing. You can see it so all you need to do is put these graphs next to each other, starting in 1992 all the way to 2015. You go year after, you can see the world shifting as you see this distribution shift. Okay. And when you do see significant differences across regions, sometimes there are clues there. So if I do this for every multiple, not just PE ratios. When I did this for price to book ratios in January 2013, do you see the outlier in this distribution? Look at Japan. Every other market is trading at 1.1, 1.2 times book value. Japan is trading at 0.67 times book value. The reason I focused in 2013 was a really good year to be in the Japanese market. I'm not saying this is going to give you a good indicator as to when to invest in a market, but if you're picking based on PE ratios or price to book or EV to EBITDA, comparing across markets might sometimes give you a clue as to which regions give you the most promise. And finally, rules of thumb drive me crazy. You heard those, right? 6 times EBITDA is cheap, peg less than 1 is cheap. So here's how I've taken to countering people who come up with rules of thumb. I just start counting. Let me explain what I mean by that. You walk into my office and say 6 times EBITDA is cheap. I'm going to say, give me a minute. And I'm going to start. And I'll come back with a list of about 3,000 companies for you that trade at less than 6 times EBITDA. I say, I didn't mean that. Well, what exactly did you mean? In fact, when you tell me that 6 times EBITDA is cheap, that suggests you've done some deep dive into the data and figured that only 10% of companies trade at less than 6 times EBITDA. 6 times EBITDA was not cheap. For instance, in early 2010, half of all US stocks traded less than 6 times EBITDA. So in 2010, if you said 6 times EBITDA is cheap, I'd show you this graph and say, tell me why. It is true that in January 2015, if you find a company trading at less than 6 times EBITDA, it's a low EV to EBITDA. But only if you're not in Australia, Japan, or Canada. We already talked about Japan. You know why in Australia and Canada a lot of companies look cheap on an EV to EBITDA basis? Especially if you use trailing EBITDA. I take the EV today, right? A lot of natural resource companies, if I take the EV today, which is low because natural resource prices have plummeted, and I divide by the EBITDA in the most recent year, hey, things are going to look really good. A lot of oil companies look like incredible bargains on an EV to EBITDA basis. Again, what I'm suggesting is not that you abandon rules of thumb. Let's make them flexible. You see what I mean by flexible? Why not take the 20th percentile every year and say, that's my rule of thumb for this year. Any number that's in the bottom 20th percentile. In 1965, we didn't have a choice. We had to make up these rules of thumb because nobody had access to the data. You didn't have Excel spreadsheets. You couldn't sort. You couldn't do pivot tables. Today, we have no excuse left. We have the entire data. Might as well use it. Right? So define, describe. Let's analyze. Remember all those assumptions about cash flows, growth, and risk you were running away from when you decided to abandon DCF valuation? I told you that every one of those assumptions will track you down. When you look at a multiple, here are the 2 basic questions you'd like the answers to. What are the variables that determine this multiple? Why do you need to know them? Without knowing them, how are you going to use this multiple? How do you decide that 8 times earnings is cheap until you've checked all the boxes that tell you it's not kind of company that just looks cheap? So what are the variables that drive the multiple? I'm going to give you a very simple device for backing that up for any multiple. Of all the things we talk about in multiples, this may be the thing you can use the most if you ever have to work with multiples a lot. Second, how do changes in those variables affect my multiple? Let me be specific. I'm going to show you in a few minutes that the price earnings ratio for a company is a function of 3 variables. the cost of equity, the riskiness of equity in the company, the expected growth in earnings per share for the company, okay, and the payout ratio you have to maintain to get that growth rate. Each measures something specific. The growth rate obviously measures your growth potential. The cost of equity measures your risk. The payout ratio measures the efficiency with which you're delivering the growth, because if you can get a higher payout ratio for the same growth rate, it's more valuable than a lower payout ratio. Those are the three variables. That answers question 1. But if I ask you how, as growth changes, will the PE change? The easy answer is growth goes up, PE will go up. Okay, but by how much? If you cannot answer that question, you really cannot use multiples well. So one of the things we need to be able to do is start to get specific. When growth goes up, how much will PE go up and why? Because without that, you can't compare companies with different growth rates. So here's the process for backing out the variables that drive a multiple. It requires a very simple discounted cash flow model and basic algebra. So here's what you need to do. If I give you an equity multiple, PE ratio, price to book, price to cash flow to earnings, go back to the simplest equity valuation model you can think of, which to me is a stable growth dividend discount model. And if you don't trust dividends, replace it with a stable growth free cash flow to equity model. You think, but this is multiples. Why am I going back to intrinsic valuation? Divide both sides of that equation by earnings per share and you got an equation for PE ratio. Divide both sides with a book value per share, you got an equation for price to book. That's exactly what I'm going to do with any equity multiple, is go back to a dividend discount model, do a little algebra, and you're going to be surprised. At the end of the process, I'm going to say these are the 4 variables that drive PE, price to book. If you're looking at an enterprise value multiple, EV to EBITDA, EV to invested capital, go back to the simplest enterprise value, discounted cash flow model, which would be free cash for the firm next year divided by cost of capital minus growth. Divide both sides of the equation by the denominator of your multiple. You'll end up with the variables that drive EV to invested capital, EV to sales, whatever multiple you're looking at. It's an incredibly simple but powerful tool for breaking apart multiples. So let's try this. Let's take PE ratios, right? Equity multiple. I went back to a stable growth dividend discount model. You're allowed to divide each side of an equation by a constant. It still stays an equation. So I divide both sides by earnings per share. When I divide price by earnings per share, I end up with PE ratio. When I divide dividends by earnings per share, I end up with payout ratio. But because I need dividends next year, there's a 1 plus G that hangs out in the numerator saying you need dividends next year. And in the denominator, you have cost of equity minus growth. That's it. PE ratio for a stable growth, dividend paying firm is a function of payout ratio, cost of equity, and growth rate. Now, if you push me and said companies don't pay out what they can afford in dividends, you're right. If you don't like dividends per share or dividends paid out, replace dividends with free cash flow equity, which is potential dividend. And what you're going to get as a determinants for a stable growth company is cost of equity growth and potential payout, free cash flow equity divided by earnings. But those are the variables that drive a stable growth company's PE. So if you came to me with a JP Morgan, that's it, 3 numbers. And you have a PE ratio of a JP Morgan. Think of this as an intrinsic PE. If you wanted to get an intrinsic PE for a company, all you need are those 3 variables. Think, but what if I have to estimate a PE ratio for Google? Problem is this approach will not work if you have 8%, 10%, 15% growth. So let me set up a slightly more elaborate version of a dividend discount model. I know you've never seen an equation like this one because we never write this out as an equation. We do it in a spreadsheet, right? If you have a high growth company, what do? You take the present value of dividends during the high growth phase. You estimate a terminal value at the end of the high growth phase and you discount it back. Trust me, that's all this equation is. In fact, see that first term in the equation? That's actually the present value of a growing annuity. It's a present value of the dividends I will earn as a company during the high growth phase. It's a growing annuity formula. The second term in the equation is the present value of a growing perpetuity. That's my terminal value. So all I've done is taken what I usually do in an Excel spreadsheet and written it as an equation. So why? It's so much easier to work with in a spreadsheet. There's a reason why mathematics is used by some. Not by everybody, but by some. It's compact. It takes what will take you 10 rows and 3 columns into one equation. But here's the other reason. One of the questions to which I want an answer to is, how will my PE change So in this case, for instance, if I divide both sides by the earnings per share, I end up with a PE for a high growth company, and guess what? The PE ratio for a high growth company is a function of three variables. It's cost of equity, its growth rate, and its payout ratio. The only difference is you have to estimate them twice. Once for the high growth period, once for the stable growth. It's incredibly convenient because if you can go do a stable growth equation, then what you get as the variables will still work whether you use 2 stages, 3. You can make this as complex as you want, but you've essentially solved the problem. In fact, let me stay on that equation. If I ask you how much will the PE change, its growth change, is one of the questions we need the answer to. Do you remember high school calculus? What am I asking you? How much will the PE change, its growth changes? How would you be able to answer that question? Take the first derivative. Trust me, I'm not going to force you to do this. I know it's been a long time. But if you can take the first derivative of that equation to growth, you can tell me how is PE. In fact, you don't even have to remember your calculus. Just spend a few $100 and buy Mathematica. Plug in the equation. You can dazzle clients with 3-dimensional graphs and how PE will change as growth changes. Because that's basically it, right? If you have the equation, you can tell me how as one number changes, the other should. So here's what I'm going to do. Since I don't remember enough calculus to essentially flood this through the equation, I'm going to take a much more simplistic route. I'm going to take a hypothetical company. I'm going to get the PE ratio for this hypothetical company with the variables, and then I'm going to change one variable at a time to see how as growth changes, PE will change. How as risk changes, PE will change. How as payout changes, the PE will change. So this is actually a high growth company with 25% expected growth for the next 5 years, a payout ratio of 20% for the next 5 years, and a beta 1. At the end of 5 years, the company becomes a stable growth company. And obviously this problem was written in a very different age. Growth rate of 8% forever, 50% payout ratio, and a beta 1. Say the cost of equity for this company is 11.5%. I come to you with this company. It's a high growth company. Say, how much would you pay as a PE ratio for this company? So here's what I did. I took the equation from the previous page. I plugged in numbers. There's my 20% payout ratio, 25% growth, 11.5% cost of equity. That's my high growth phase. 50% payout ratio, 8% growth, 11.5% cost of equity in the stable growth phase. If you plug the numbers in, the intrinsic PE ratio for this company is 28.75. Let me back up and explain what I mean by intrinsic. This PE ratio comes from using a 2-stage dividend discount model, right? If I took this company and put it through a 2-stage dividend discount model, the value I would get would be roughly 28.75 times the earnings. You say, why, if we're going to do this, why not just do a DCF valuation? You're right. If all I cared about is the DCF valuation, why bother specifying it as a PE ratio? Here's why I thought it was useful. You're paying 28.75 times earnings. Pretty high PE, right? What's so attractive about this company that it deserves the 28.75 times earnings? It's got a high growth rate. So what's your nightmare scenario with a high growth company? You pay a high PE up front. What could happen, Joseph? You wake up tomorrow. Forget about never realize. Tomorrow you wake up and the company says, hey, you guys, remember the 25% growth rate? Just move the decimal point 1 point over. It's 2.5% growth rate. It's a disappointment, right? The way it manifests itself, the PE ratio is going to collapse. So one of the first questions I asked was, if I kept everything else constant and changed just the expected growth rate in the next 5 years, what will happen to the PE? Now, no surprises. If I keep everything else constant and lower the growth rate, so as my growth goes from 50% down to 5%, my PE drops. You say, why are there 4 separate columns? I looked at 4 interest rate scenarios. I didn't even think of a 2% when I did this because I didn't think that was likely to happen in the US. So you can actually add a 2% if you want. So these are risk-free rate scenarios. 4%. So low interest rate for me was a 4%. High interest rate was a 10%. Under every interest rate scenario, the PE drops. So the blue you see up there is for a 4% T-bond rate. The whatever the disgusting color at the other end is a 10% rate. So under every scenario, the PE ratio drops. So here's my follow-up question. Under which interest rate environment is my PE ratio most sensitive to changes in my growth rate? Low interest rates or high interest rates? It looks like at low interest rates, my PE ratio collapses more. My second question is an intuitive question. Why is that happening? Why is it happening? What's the value of growth? way out there, right? When interest rates are high, what happens to the value of growth across the board? It gets lower. In fact, let's take an extreme scenario. Let's say you were in Brazil in 1991. Interest rates have just hit 5,500%. What's the value of growth? What growth? Who cares? What if I surprise you and tell you you're going to have twice as much growth as you thought? You say, I don't care still. Half as much? I don't care. Growth ceases to have value at very high interest rates. You stop rewarding companies for growth. You stop punishing them for delivering much lower growth. As interest rates get lower, across the board, growth is going to become a bigger proportion of your value for all companies, and it's going to be more sensitive to changes in the growth rate. Yes?
Is this consistent on percentage terms?
It's consistent even on percentage terms, and you can see it, especially as you get to really high rates. Did everybody get that point? That's a very good point about, is the percentage change in PE also going to be lower? You're going to see that show up. It's not as huge a difference, but you see it showing up still. You're saying, who cares? What interest rate environment are we in now? A really low interest rate environment, right? How do you get these growth surprises? What form do they take? Do you get an angel in the middle of the night who wakes you up and says, growth has dropped? No, I don't think so. It's usually because you get a earnings announcement from the company containing news that says, you know what, that 25% growth, you're over optimistic. You know what this graph is saying? The effect of earnings surprises. To me, that's the essence of an earnings surprise, is who cares about what it tells you about last year's earnings? It's telling you about future growth. The effect of a negative earnings surprise in this market is going to be greater than the effect of a negative surprise was 10 years ago, 20 years ago, 30 years ago. The effect of a positive surprise is also going to be greater. So what you're going to get is much bigger movements in price for surprises. Not because markets have become irrational, but that's what this is one of the costs of having really low rates, is you're going to have volatility around announcements because everything is going to get magnified. So when I see an earnings surprise come out from a company in this market and I see the stock price jump in either direction, I think that's exactly what you should expect when rates have become 1.8, 1.7, 1.6%. And maybe this should manifest itself as a higher equity risk premium. I'm not sure. But that's something to think about when you think about why are prices moving so much when we get new information. Any questions? I also kept everything else constant and lowered my, and I used a beta 1 and I lowered the beta and raised the beta. Again, no surprises. As my risk goes up for any given growth rate, the PE ratio is lower, which makes sense, right? A lower risk high growth company is worth more than a higher risk high growth company. But here again, let's focus on the intuition here. I've actually looked at 4 different high growth scenarios, 25, 20, 15, and 8. Let me take a company here. Take this company over here. That's a company, the beta of 2 and a growth rate of 20%. So it's trading at about 7.5 times or 8 times earnings. I come to you, you're my advisor, and I say, look, I want to have a higher PE ratio. And at one of 2 routes I can follow. I can go for more growth, in which case, where am I stuck? I'm moving up and down in this last segment. Or I can go for less risk, in which case I'm moving across the graph this way. I actually think you're going to get a much bigger payoff by focusing on reducing your risk exposure than going for more growth. The reason I bring this up is often managers in growth companies get so focused on growth, and more growth that they sometimes forget that there's a risk dimension. And once in a while, it might make sense for you to take your eyes off the growth and focus on the risk, saying, maybe we're in a market that the payoff to reducing risk is greater. And to me, this is one of the things that Amazon did well in 2001. When they recognized the market was changing, they were willing to take their eyes off growth and say, we have to survive and bring risk down. And then we can worry about growth later. Whereas a lot of other technology companies were unable to do that. It was devastating for them. So when you think about growth and risk, think about those choices. Now, so let me back up. So basically, high growth increases PE, high risk reduces PE, and the payout ratio effect is going to be through basically what kind of return equity you have. So high return equity companies should have high PE. One of the things I'm going to ask you with every multiple is to design your perfect undervalued company. Okay? So let's do this with PE ratios. You want a company with a low PE or a high PE? You want low PE. You want a company with low growth or high growth? You want high growth because otherwise, so you want low PE, high growth, low risk or high risk? Low risk. So you want low PE, high growth, low risk. You want low return equity or high return equity? Return. See, what chance do I have finding something like this? No harm looking. If you're thinking about building screens, that's the essence of building screens, is you're looking for mismatches, right? In fact, you can do this on Capital IQ. You can go look for every company that trades at less than 10 times earnings. You're going to find dozens and dozens, hundreds of companies. Then look for every company that's trading at less than 10 times earnings that has growth rates greater than 20%. All of a sudden, hundreds of companies are going to become probably 80 companies. Then take those companies and say, I want these companies which have had stable earnings. And that might require some definition of what you mean by stable earnings over the last 10 years. That might make the 80 companies become 18. Say, I want only those companies that have returns on equity greater than 25%. You might end up with nothing. Or you might end up with 2 or 3. Don't be stupid and pick up the phone or get online and buy the 2 or 3 right away. There might be something else going on. But the reason I use screens is to decide what I'm going to value next. Because if I say I'm going to start with A and work all the way to Z, that's a lot of companies I'm going to be hitting and missing on, right? I want to focus my energy where I think my odds of finding something misvalued is greatest. And that's the biggest plus of using screens, is you might be able to isolate those companies where a DCF valuation can actually deliver that. So what I'm going to do is actually take the foundation we've built and essentially let you play devil's advocate, because I'm going to play the role of an analyst and I'm going to put out recommendations to you and I want you to shoot them down. So here's my first try. I'm the emerging market allocation analyst. What do? I tell people where to invest. I show you these PE ratios. You say, you know what? Put all your money in Russia. It looks cheap. Look, it's 4 times earnings. This is a pretty obvious case, right? What am I missing here? Lots of risk. So you get the template, right? So anytime I show you a graph, I want you to tell me, you might still make the investment, but I have to bring it in, right? So what we're going to start off with next session is starting to use statistical tools to be able to do it, because it's not always this obvious. This was an obvious case, but we play this out on a repeated number of scenarios, and you're going to see exactly why knowing what variables drive the P/E ratio is going to be useful for you. Okay, so I'll see you on Wednesday.
What I actually did is I put a terminal growth rate of 2%, but I also increased my or should I just, I don't know, but as long as it's consistent, it's alright. What happens if
yeah, good luck. I think it's not that bad, really.
I'm hoping I can get it done before the